In this week's update, process wins again over emotion. Outstanding high probability stocks are everywhere, and how to find these stocks and execute with a clear plan. My name's Garry Davis, and as always, this is general advice only. And remember to subscribe and like the video. All right, so much has happened in the last couple of weeks, and I guess still is unfolding. But it's worth doing a recap of where we were at just last Sunday, because I think a number of things have played out pretty much as I thought they may. So let's just do a quick recap on how I saw things last Sunday. And we looked at the correlation, the very, very strong correlation at the extremes between the VIX index and the S&P index. And the issue there was that it was indicating that we were probably at a near-term low. Now, there's been a couple of instances in the last 20 or 30 years when the near-term low has taken a lot longer to form, but most of the time it's generally pretty brief. It's only a week or a couple of weeks at the most. So therefore the odds heavily favoured a near-term low, and that's exactly what we got. It was pretty much the next day was the low in the US market. The other thing that I touched on was what the best and worst outcomes for the market would be. Not necessarily for the economy or for anything else, but what would the market like the best and like the least. And what I said was that the best outcome was a Republican Senate, and the Democrats had the remainder, and that appears as though that's how it's going to be. And the market has responded really quite positively to that. The worst outcome, I said, would be a long drawn out contested court battle. That is still possible. Trump is not going to give in very easily, but it's probably looking like he doesn't really have much of a basis to go forward on that. So the market is looking at things pretty confidently at this point in time. And I also said get ready to pounce and to focus on the megatrend stocks. And we've just had an extraordinary week for a lot of those megatrend stocks. And I'm going to show you just a couple, just as an example, not recommendations, but just as an example of what happens when you get on the right side of the trends. So let's just jump in and take a look at the VIX. So this is the VIX as I covered it last week. This is going back to 1990, so 30 years. And you can see we had two huge events in the VIX where we got above 50. One was in the GFC and the other one was in March of this year. And all the rest, where we poked up just above 40, you generally got a near-term low in the S&P very, very shortly afterwards. And that's what made the probability of that happening again pretty good, because there was no way that the situation we were in last week was as bad as the GFC or the start of the coronavirus in February. Let's just zero in a little bit and look at the last 3 months. So the VIX had been running along in the low 20s. We did get a bit of a spike in early September, spiked up to about 33, 34. Then it dropped back again. And then we got this big spike just before the election, went up into the 40s, and that was what I talked about last weekend. Well, you can see now that we've come all the way down and we're under 25 now, so we're pretty much back to normal. So that relationship between the VIX and the S&P index at the extremes is again has proven to be an extremely valuable indicator, and I will come back to that point. There are literally hundreds and hundreds of high probability targets in the American market, and there's certainly many stocks in the Australian market that tick all the boxes, all the things that are important that lead to outsized gains. There are just hundreds and hundreds of them, and they're all fairly high probability in terms of playing out. And that's why I've been so enthusiastic and positive all year, and why I remain in that position despite the virus, despite some of the uncertainties. The market marches on. All right, the vital learning points that came out of last week, and this is really important because, you know, amongst, as well as a market update, I want this forum every week to provide some sort of useful educational purpose as well. So the vital learning point is that if you can remove emotion from your decision-making process, and admittedly over the last few months, I mean, it's not easy to do, But if the more you can remove that emotion from the decision-making process and you just focus on the high probability factors, things like the relationship between the VIX and the S&P, use it to your advantage. Things like the megatrend stocks. So try to guess the impact of the elections, who's going to win, what does it mean for the market, the same with the virus. It's just a complete waste of time because they're all just short-term issues. They don't change the long-term direction of the market. Now, if we go back 3 weeks, the weakness that we saw in the week following options expiry, which was October 19, that week is almost always generally weaker than the weeks preceding it or after it. And so that was a high probability event that we would get weakness in the third week of October. And we got weakness in the third week of September as well. So these are the sort of things that you want to use rather than getting hung up on, who do I think is going to win the election and how's the market going to react? I mean, that's impossible to know. So it's pointless. Just focus on things that have a very high probability of recurring. The VIX and the S&P correlation was very high for a near-term low, and waiting until we actually got confirmation following the election. So Wednesday was the time to move. So acting immediately on confirmation of that was also a high probability situation. So you don't need to do anything radical here. You just need to do simple things consistently. So again, we didn't guess about the outcomes. We waited. We understood what the outcome probabilities were, but we waited until we got confirmation. We didn't try and predict what the outcomes would be. We just did the simple things, the simple high probability things that we can see. And just forget the rest. Forget all the rest of the media noise and all the biases that are probably in your head about how you think it should be. The more you can try and push those things to the background, the better. Because it works and it'll keep working consistently. So that's the process, winning over emotion. The most valuable commodity that traders and investors can have is a very clear, unemotional perspective on what works and what doesn't. And I put a great deal of time and effort in Portfolio Analyst and in the Insiders Club, but particularly in Portfolio Analyst, at covering that sort of perspective every single week so that members are right on top of things. And if you've not been in Portfolio Analyst, you've not taken the trial, then I'd really urge you to at least have a look at it. It's only cost you $1 for 2 weeks. And I think you'll find a great deal of very valuable perspective that can just make negotiating the sort of periods we've had this year so much easier. The still risks remain, obviously. The election risk is now removed. The market positive, I guess, is that with a split Congress, we're not going to have any sort of really radical policies from the Democrats. So it's going to be an administration that's not going to be able to get a great deal of things done. The market negative is that they're also not going to be able to get the huge stimulus that the Democrats were angling for. So that's a bit of a negative for the market. But to my mind, those two things sort of balance out. We're not going to see any radical policies. We're going to see significant stimulus. It's probably going to be short of what the Democrats would have had, but those things cancel each other out. We've still got the virus risk. But again, I think that's just a transient situation. It doesn't change the megatrends. It doesn't change the evolution of 5G or artificial intelligence or biotechnology or all those other megatrends that are going to go on regardless. So the big picture megatrends and the earnings, and we've seen some sensational earnings in the last week or two, they're just going to swamp out the virus impacts. But we are going to have periodic volatility because there's plenty for the markets to worry about, and we've got computer algorithms that just love to push the market from one extreme to the other. So expect to see periodic volatility, but expect to see the megatrends and the earnings in those megatrends to continue to prevail. So where to from here? If you want safety, if you're a more conservative investor and you're looking for safety and performance, then to my mind, you must go where the growth is. Trying to hide in dividend stocks is really not the place to be. We've seen, and I've talked about this a lot in recent months. So many dividends are being cut in Australia, it's hard to see them being reinstated. And even if they were, you're probably not going to make too much on the capital gains side either. So if you focus on where the growth is, then there might be a few potholes along the way, but the growth will overcome anything that comes up. Whereas if you're in a no-growth company, then you've really got nowhere to go. So if you want safety, it's where the growth is, and it also is going to provide you with good total returns. The dividends might be smaller, but the capital gain more than makes up for that. And if you need some money, you don't have to have it come to you in a dividend stream. You can just sell a few shares. You know, it's not a particularly difficult thing to do. Now, there is plenty of small cap growth in Australia. There's no question about that. And we're going to have dozens and dozens and probably more than 100 stocks in Australia that are going to do incredibly well over the next few years. But investing and trading in small caps does bring volatility issues. And for some conservative investors, that volatility is just too much to handle. And I understand that. The alternative is to go into the large cap stocks that are tied to the mega trends, the large cap growth stocks. But there's almost none of those in Australia. So you've really got to go overseas. So if you are just in the Australian market, then just recognise that you're only tapping into around about 2% of the total global market. And many of the mega trends are not really available here yet, if they ever will become that way. So you've really got to consider looking at overseas to get access to those sort of things. And I think that's where you're going to get safety and performance. Now, just touching on the megatrend stocks, just to wrap up before we start to look at the markets in detail. Look, many of the megatrend stocks are at seemingly silly levels. I grant you, and some of them are becoming highly dangerous. But a few are going to justify it. Most won't, but a few will. And they still total up to, a lot of stocks in America, probably well in excess of 100 stocks that I think have a very high probability of doing outstandingly well in the next few years. So there are many wonderful alternatives out there. The question is, how do we de-risk the process of investing while we still leave open the high growth probability? And it just comes back to, it's just a clear, simple, straightforward process of, first of all, the stocks that are almost certain to continue growing earnings and therefore growing their share price. And then just staging your entries, your partial profit taking, and your overall exposure according to what the market is doing at the time. It's just clarity around what you're doing. All right, let's look at the American stocks. The S&P basically raced up nearly 7.5% last week. So it was a huge week. The economic data continues to come through. It's certainly not getting in the way. It's supporting the stock market. Earnings are coming through really, really well. So that's a real positive as well. The two critical elements, obviously, and this has been the case for some time, is the market is responding in part to the very large fiscal stimulus programs. There's no question about that. It's injecting an enormous amount of additional money, some of which is going into the stock market. But the second thing, and I think the more important one, is earnings and revenue growth on those megatrend stocks. If you just had a fiscal stimulus program, but you didn't have earnings and revenue growth at really, really high levels, and I'm talking here about the stocks that are beneficiaries of basically the virus and the lockdowns. If you didn't have the earnings growth, then we wouldn't be getting the market performance that we are. So the two go hand in hand. Now the US dollar fell sharply down to 92.23, and the 10-year yield also slipped back a little bit. So let's take a look at some charts. All right, so we'll start with the S&P. This is where we were basically last Sunday, and you can see we've now moved back up to almost to the top of the trading range, and we're only around about 2% shy of the all-time high on September 1st. So it's been volatile since September, but net, we're still almost at all-time highs, so a pretty amazing situation. Now let me just show you just a few of the stocks that I've been talking about. So this is a combination of stocks that have come out with amazing earnings performance. They were already trending generally pretty strongly. And again, these aren't recommendations. These are just examples to make the point that I'm trying to make, that there are parts of the market where you can do incredibly well with a high degree of reliability. Now, if we look at QRVO, they're in the semiconductor space. They came out with earnings $2.17 actual versus $1.94 expected. They've easily beat expectations. Now, they're a very key beneficiary of the cycle that's just getting started now, and that's upgrading from 4G to 5G in not only mobile phones, but in the internet area as well. Now, you can see it was already trending very strongly, and we're just entering a very strong time of the year for semiconductor stocks. But look at the market response to the earnings. It was tremendous. Let's look at Keysight, which is a company involved in and they're a fairly large cap company, 17 billion market cap company. They're involved in 5G testing and measuring. And so that they allow the 5G networks of the future to function far more effectively. So they're an essential part of the 5G revolution. Now, they've been building up to a breakout for some time now and managed to achieve that on Thursday and Friday. Now, I don't know what this is going to do in the short term, but I do know that over the longer term, this stock is beautifully placed for the mega trend that's in place. Let's look at Corning. Corning makes glass, which is used in fibre optic networks, but also in mobile phones. And this is one perhaps for more conservative investors, because this is a play on the rapidly rising internet usage and 5G, which is going to require about 100 times the amount of fibre that currently exists. So there's going to be an enormous build out around the world over the next 2, 3, 4 years. So tremendous opportunities with a stock like Corning. Let's look at Qualcomm. They delivered absolutely explosive growth. Revenues were nearly more than $500 million more than expected. And earnings came in at $1.45 against $1.18 for the quarter. And the company raised guidance on both top and bottom lines. The market loves that. Look at the response. Huge gap up on big volume. Let's look at the trade desk. Absolutely blew away revenue and earnings estimates. Revenue growth was 32% year on year. They're benefiting from just a massive shift in where advertisers spend money into streaming TV. So that's been an enormous breakout and move. It was already trending very, very strongly. And this is the semiconductor space in general. This is one of the strongest times of the year for semiconductors. So it's always a good sign when semiconductors break out, and that's what's happening. We were at all-time highs. In fact, we've been trending up, but we've now broken out. So this is a very good sign for the sector and for technology in general. Okay, let's take a look at the currencies. So the US dollar has slipped down again, as you can see. This has been quite an emphatic move in the last week. So I wouldn't be surprised if we break out the bottom of this consolidation that we've had here while the election got decided, around about 92. If that breaks, then we're looking at the next support level kicks in around about 89.5. Mightn't seem like a lot, but in currency land, that's a fair bit. And that will certainly be a significant positive for gold. The Australian dollar is really just the inverse of that. So we've got a consolidation that's happening at the upper level, and I guess it's not beyond the realms of possibility that we could start to push up, break out of this level, and start to push up towards 75. But look, if you've got money in America and you're in the sort of mega trends that I'm talking about, and you're also in precious metals, then you're going to do far better than the negative effect of the currency moving higher. So I wouldn't be concerned about that. All right, turning to Aussie stocks now, 72.36, that's where we finished. We've got US dollar weakness, we've got commodity strength, and I expect that commodity strength to remain pretty good for most of the next 5 years. So the downside in the Aussie dollar looks to be somewhat limited at the moment. Now the ASX 200 reversed up 4.4% for the week. We may see some further gains on Monday, but not quite the 7.3 that we saw in the US. But small caps, which have been pretty heavily belted around over the previous couple of weeks, small caps in Australia, at least the good ones in the right areas, had a major bounce back last week. So that was excellent performance from the Australian small caps. Let's just look at the ASX 200. So you can see we've been in this range here at the index level from around 5750 to 6200. We're almost back up to the top of that at the moment. Let's just break it down a little bit. There's the energy sector, clearly still in downtrend, a little bit sideways lately, but still below the 200-day moving average that's falling. Banking sector is still really going sideways, but still only just hanging around the 200-day moving average, which is still in decline. Healthcare has done reasonably well. We're doing it certainly better than other sectors. If we look at materials, and you can see materials, the 200-day moving average, you can see just how starkly better the materials sector has done than even the healthcare sector of late. And if we look at small caps also doing okay, above the 200-day moving average, which should start to turn up fairly soon. All right, let's look at gold while we're here. So gold had a very strong week. You can see we jumped back up, well up above the 1900 level again. And if we look at this on a daily chart, you can see we've now broken this downtrend line. So there was our downtrend. So we've now broken out of that. We've gone above these highs, these consolidation highs that we'd seen over the previous few weeks. And it's all looking extremely positive for gold. And with the US dollar, looking quite weak, then that's going to be another factor. But I would have to say that gold went up by more than the currency effect last week. So this was a decent move back into gold as well. Silver, not to be left out, also looking pretty positive. And just checking in on GDX. So GDX has also broken the downtrend line as well. And some of the smaller to mid-cap gold and silver stocks in the States are doing far better than GDX, a lot better. Okay, so precious metals, we're up $63 to 1953. And then precious metals, the only thing that bothers me about the precious metal stock still is that we still haven't had the washout from the excesses leading into the August peak. But as I've said a number of times in recent weeks, it may just get dealt with by time. But we now have broken the downtrend, so I think you can start to ratchet up your precious metals exposure a bit, but I would still be a bit cautious about going too hard on precious metals at this point in time. Turning to other commodities, copper was up to $3.14 with the currency. Crude oil, which was absolutely smashed the previous week, did a partial bounce back. Looks like a big percentage number, but it's only regaining part of what it lost the week before. My overwhelming advice when it comes to the crude oil sector is resist the urge to play the turnaround story. It's just not a high probability thing to do. There isn't any momentum in this sector at the moment. So from my perspective, particularly in America, strength begets more strength. Stay with the momentum, stay with the mega trends, and I think you'll do far better than trying to pick turnarounds in the airline sector or in crude oil or in some other sector that's got headwinds all over the place. All right, there's the spot copper chart. And so wrapping things up now, it was a tremendous finish to the week last week, but this is just the start. if you've got a game plan sorted out, and it's just so important. You can't just wander into the market and just, think you can take some stock tips and do well. There are many, many ways to do successfully well in the market, but you need a game plan. You need to apply that game plan consistently. And the second thing that you need is a very large list of targets. If you want to buy 10 stocks, you don't want to have 10 targets, because then you'll be tempted to chase prices. And that's the worst thing you could do in this sort of volatile market. You need a large list of targets. I've got hundreds and hundreds on my list that I follow every single day. So they're the two things that you need. I believe we've got still years ahead of us of a very, very productive market in the mega trends. Now, Portfolio Analyst coming up is, again, just dealing with the absolute avalanche of opportunities that we've got. And again, just a reminder, if you haven't tried Portfolio Analyst, there's a 2-week trial for $1. It's well worth your time to spend 2 weeks on that. I think you'll get a lot of very valuable education and perspective, if nothing else. So that's it for this week. There's my website details and email address for those that may require it. And I'll be back with you next Sunday. Cheers.